stuff they're going to do next will be more extreme versions of what they're doing now, and it'll be okay, because the old stuff was pretty successful, all things considered. We're not in 1930s style depression. And they want you to ignore the fact that it required, a doubling of the U.S. national debt, an almost quintupling of Chinese total debt to get us here, and a huge increase in debt and unfunded liabilities in Europe. We needed to borrow huge amounts of money, historically huge, unprecedented amounts of money, to keep things going. And going forward, we need to continue to borrow even more money year after year after year. At some point, there are no tools to stave off the debt collapse that comes from this kind of leverage. If we, going into a recession, already have record consumer debt in the U.S., record auto debt, record student debt, record corporate debt, and record government debt, taking on huge amounts of new debt is probably not going to be the thing that brings back the normal times of the 1980s and 1990s, when we basically, grew steadily and there were lots of jobs. Those times can't come back under the current regime.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with your SD Weekly Metals and Markets Wrap, and with us today is John Rubino from DollarCollapse.com. John, thank you so much for joining us today.
Hi Elijah, it's good to talk to you again.
All right, great. Well, the first topic I'd like to discuss today is the precious metal markets. What's your perspective on the recent price action? This week, both gold and silver are down just slightly.
It has been so boring lately in precious metals. The gold bugs of the world have been waiting for the next explosion in price and watching every fiat currency indicator out there that usually correlates with gold and silver prices go through the roof. We're creating an accelerating amount of new debt in the world on top of this mountain of debt that we already created in the last 30 years. It's getting worse and worse from the point of view of systemic leverage pretty much wherever you look. And that's usually really good for precious metals prices because gold and silver are where you hide out when governments are screwing up their currencies. And by any measure that you want to use, the screwing up of the world's main fiat currencies is accelerating, but gold and silver aren't taking off. And that's frustrating, to say the least, for people who correctly interpret what's going on out there is really dangerous and bad, and look at history and see precious metals as the safe haven in these kinds of circumstances. And it's not happening right now. You've got other kinds of assets absolutely going through the roof. For instance, there was just a painting that sold for almost $500 million. Paul Newman's old wristwatch sold for $17 million just lately. And that goes on and on. The collectibles market and fine art and other things that are related to collectibles that rich people tend to put their money into as an alternate store value, those things are going through the roof. But gold and silver aren't. So they're kind of being left out. And it's not completely clear why. There are a lot of theories out there. It's being manipulated by governments because gold in particular is a competing currency. When it goes up, it makes the dollar and the euro and the yen look bad. So it's in government's interest to depress the price. That's one theory. Another theory is that the rise of Bitcoin and the other cryptocurrencies are siphoning off a lot of the flight capital, the safe haven money that might otherwise have flown into gold and silver. That's possible too. And it's also possible that this is just one of those times when something takes longer to work out than you would think that it would, of which we've seen a lot in the last couple of decades. It always seems like bubbles are going to burst long before they actually do burst. And I have a painful personal history of being too early with bubbles. I wrote a book on the real estate bubble in 2003. The real estate bubble didn't burst until 2007. And James Turk and I wrote a book about gold in 2004, and gold didn't really take off until 2008 or so. So it takes a lot longer for these things to work out than at least seems reasonable to me and people like me. This just might be another one of those times when the stock market is way ahead of itself by any historical measure. We should have a stock market bust. We should have had one already, but it hasn't happened yet. Gold and silver are fundamentally undervalued when you compare them to the amount of fiat currency that exists in the world. But that fundamental undervaluation hasn't been rectified yet. They haven't gone up to the point that you can look at them and say, okay, based on the amount of paper that's out there, gold and silver are fairly valued. We are nowhere near that. Gold would have to be about $10,000 an ounce for it to balance out the amount of dollars and euros and yen and yuan, et cetera, that exist in the world right now. So based on, my own experience and longer financial history, imbalances eventually do work out. Fundamentals are the things that eventually determine value out there. And so I think we should still be confident that gold and silver are going to have a monster run at some point in the not too distant future. But it's hard to, it's hard to sit there while some other things are going up and not feel very impatient. I feel for the people who own junior mining stocks right now, or have a lot of bullion sitting in various places in their house and safe deposit boxes and vaults overseas. These things aren't up the way a house in most hot markets is today, and as tech stocks are. And there are a lot of other things you could have put your money into 5 years ago that would have done a lot better than gold and silver. But the gold bugs of the world, we have to console ourselves with the expectation that those trends are going to reverse at some point. Gold and silver will wildly outperform Google or Tesla in the not too distant future, and probably outperform Bitcoin because gold and silver constitute the really undervalued asset in this marketplace right now. And undervalued assets tend to do better than fully valued or overvalued assets as everything is working itself out. So I think the next few years will be great for gold and silver, but we have to be patient until that trend really gains traction.
Definitely. And as you were saying, that, you sometimes have predicted crashes a little earlier than they've actually happened, but as they say, it's better to be a lot too early than, just one day too late. One of the things, though, that you've talked about that seems to be signaling that a recession is coming is the yield curve right now and how rates are compressing. Can you talk about this?
Yeah, one of the signs that we're near the end of this cycle is that the yield curve has become front page news. And that is something that almost never happens. There's a stretch of maybe 6 months at the end of big cycles when the yield curve becomes interesting to the financial press. And this is one of those times. You're seeing stories out there on almost a daily basis, checking in with the yield curve and telling us what's happened. The reason for that is that the yield curve is starting to change dramatically. Now, what the yield curve is the difference between long-term interest rates and short-term interest rates. And the theory behind its relevance is that banks make money by borrowing for short periods of time at low interest rates and then lending that money out for longer periods of time at higher rates. They make that spread, and when the spread is wide, in other words, when long-term rates are a lot higher than short-term rates, banks can make good money. And so the financial sector is very healthy, and you get spillover effects into the rest of the economy, which leads to a recovery. At the peak of cycles, however, the yield curve tends to flatten and then invert. In other words, long-term rates fall below short-term rates because people are expecting a slowdown in the credit markets, and so they buy long-term bonds really aggressively, which